Welcome to the Deep Dive. Today we're unpacking a really dense stack of listener sources, all focused on the deep emotional and psychological side of investing.
Mm.
Specifically, what happens when your conviction, the conviction you build over months of deep fundamental research, just slams head on into the daily reality of market prices.
It's the ultimate test of temperament, isn't it?
It really is.
You've done the work, you've traced the cash flows, you believe in the management team, the competitive mode, all of it.
Right.
But then you look at your screen and the stock is down 40, 50, maybe even 60%. The market isn't just saying, we disagree.
No, it's screaming, your analysis is fundamentally wrong.
Exactly.
That's right.
And that's where the real work begins.
And that, according to the fantastic material shared by Mr. Schmidt and others, is where conviction-driven investing really starts. So our mission today is to give you the frameworks to navigate this high-friction world. We're going to dissect the psychological pressure points, cognitive dissonance, loss aversion, and of course that old demon, FOMO.
And we want to help you distinguish between being early, patiently waiting for a thesis to play out, and just being plain wrong.
Just being stubborn.
Stubborn, yeah. Suffering from confirmation bias because your ego is suddenly all tied up in this one position. And crucially, we need to understand that moment when conviction stops being a strength and actually becomes a liability.
Let's jump right into that core tension.
Mm.
What is actually happening in an investor's brain during that first major drawdown? When they fundamentally believe in the business, but the price action is it's devastating.
What you're experiencing is cognitive dissonance. It's a concept from the psychologist Leon Festinger.
Okay.
And it's that intense mental discomfort you feel from holding two contradictory beliefs at the same time. Belief A is, my fundamental analysis is sound, this business is undervalued.
And belief B.
Belief B is, the market, which reflects billions of dollars and thousands of smart people, says this stock is worth half of what I paid for it.
And that second belief is so powerful because the price feels objective. It's right there, it updates every second, and it carries the weight of consensus. It's really hard to stand alone against that when your own money and, let's be honest, your ego are on the line.
Absolutely. And to make it worse, the sources highlight a critical related bias, uncertainty avoidance.
Okay, so this is different from just risk aversion.
Very different. It's a deeply human trait. It's the brain's aversion to unknowable paths and indeterminate timelines.
Well, hold on. Isn't avoiding an unclear path just prudent risk management? I mean,
Yep.
We're always told to stick to what we know.
That's the subtlety of it. See, if I told you there's a 50% chance of losing $100, that's quantifiable risk. You can process that.
Right.
Uncertainty avoidance, though, is the discomfort of holding, say, an asymmetric microcap where you know the potential payoff is maybe 15x, but the path to get there is totally opaque. There's no clear timeline for regulatory approval. Management turnover is a risk. The market could ignore the story for years.
So the brain prefers the known, mediocre certainty, like an expensive but stable blue-chip stock with a predictable 8% annual return.
Exactly. It prefers that over the uncertain, potentially magnificent return of the asymmetric bet. The pain of the unknowable timeline feels worse than the known lower outcome.
And you end up selling out right before the catalyst hits, just to get rid of that mental burden.
You trade a potentially great return for short-term mental clarity. It happens all the time.
And if that wasn't enough, the sources remind us this discomfort has a twin that hits from the opposite direction. What happens when your position is way up, say 150 or 200%?
The discomfort just shifts entirely. You watch your profits stall, and then they start to retreat, maybe cutting your gains in half.
Yeah.
And now the internal conflict is, okay, I was right, the thesis played out, but did I hold on too long? The same conviction that helped you hold through the drawdowns now becomes the very thing stopping you from selling into strength. You go from feeling you're wrong to fearing you made the wrong exit decision.
That perfectly sets up part one. Navigating that entry and the tension between being early and being wrong. Because on the surface, if you're just looking at the price, they look identical.
They both produce losses and trigger that same self-doubt. And the only real psychological shield you have against this pressure is genuine conviction.
And this is where the source material draws a really crucial line between genuine, self-researched conviction and what it calls copied conviction.
Well, let's talk about that copied conviction investor.
Yeah, let's do that.
When their stock drops 50%, they are just utterly paralyzed. Their confidence was completely outsourced to an analyst or a financial celebrity or some newsletter.
They're relying on external validation, And when the external world is screaming sell,
They have no internal recourse. They're just waiting for that same external source to give them permission to exit, which, rarely happens at the right time.
whereas the genuine conviction investor has already stress tested their own thesis.
Exactly. They might still be wrong, but when the price drops, they don't look outward for answers. They look inward at their original analysis of the business. And that resilience, that's the difference maker.
This internal weakness directly feeds into the FOMO trap on the way in, the fear of missing out.
Mm-hmm.
This isn't just about missing a trend. FOMO drives an investor to buy pure price momentum, totally detached from any fundamental thesis. They see a stock that's already up 200%, and they jump in just because the pain of watching it go higher without them is unbearable.
And this trap is ancient. I mean, we only need to look at the story of Sir Isaac Newton and the South Sea Company in 1720.
Right.
Newton got involved, made a very substantial profit early on, and he sold out. A perfectly rational move.
But then he just watched, mortified, as other people kept making fortunes as the stock went even higher. For someone who believed in orderly, predictable systems, the FOMO must have been just excruciating.
It was unbearable. He bought back in at the absolute peak of the frenzy, paying insane prices.
And we know how that ended.
When the bubble collapsed, he lost a monumental sum, millions of dollars in today's money. The most rational scientific mind of his generation was undone by the psychological madness of crowds.
The lesson is so clear. FOMO-driven entries lack that bedrock of analysis, so they inevitably lead to FOMO exits. The second the momentum reverses, you're out. You had zero psychological resilience.
So the key takeaway for entries is really about separating stubbornness from conviction.
Okay.
Stubbornness is just an attachment to being right. It's confirmation bias, where you only look for evidence that supports what you already believe.
But true conviction.
True conviction requires continuous critical re-examination of your thesis. You have to remain genuinely open to new information that could prove you wrong.
That continuous re-examination is your practical anchor then. You have to regularly check your thesis against the current reality of the business, not just the stock price.
And another crucial anchor the sources detail is separating time from return. This is so key for managing the psychological burden and how you size your positions.
How so?
Well, if you think your investment will return 3x, being early for a year is really difficult. But if the potential is 15x over 5 years, the psychological calculus just changes completely.
That changes everything. It changes the size of the position you can stomach, the patience you need. If you know the payoff is truly asymmetric, waiting 3 years for zero gain feels very different.
It does. It informs your sizing and your ability to weather that initial period of market indifference. And this brings us to a practice that Mr. Schmidt highlights, the forcing function of writing.
Ah, yes.
Yeah.
Because conviction is so easy to fake privately, just in your own head.
Ridiculously easy. Oh yeah, this company's great, I trust them. But the moment you have to write out a specific thesis, say for a public audience, or even just a detailed note for yourself.
You're forced into specificity. You can't just hand wave away the cash burn or the rising debt.
Right. That friction of articulation is a feature, not a bug. Writing forces you to explicitly state the bull case, the bear case, the valuation, the catalysts. It exposes lazy thinking and turns private hope into external, accountable analysis.
Let's transition now to that second great challenge, exits and profit-taking. This is often so much harder than the entry. When does that great conviction become a liability?
Well, the central dilemma is that your original entry thesis, say buying a great company at 3x annual sales, doesn't have a sell signal built into it. It doesn't tell you what to do when the stock triples and it's suddenly trading at 8x sales.
And the emotional response is so powerful. But I still believe in this company. The story is getting even better.
Right. But the intellectual answer has to be about whether that new 8x multiple is actually justified by new information or if you're just suffering from emotional attachment.
And that attachment is supercharged by a couple of classic exit traps.
2 primary ones. First, loss aversion. We feel the pain of a loss roughly twice as acutely as the pleasure of an equivalent gain. This is why investors will desperately cling to an underwater position.
They just hold on, hoping it'll get back to break even, just to avoid that psychological pain of admitting they were wrong.
And the second trap is the endowment effect. You start to overvalue a stock simply because you own it. That $50 stock you bought at $100 feels like you're losing $50 when you sell, even if redeploying that capital into a better opportunity is the purely rational move.
You've endowed that $50 with the emotional history of the $100 purchase price.
Exactly. And this psychological resistance creates a myth among investors who misinterpret capital preservation rules.
You mean like Warren Buffett's don't lose money?
Correct. They read that rule as a mandate to never realize a loss. But the sources are clear. The rule is about preserving your capital. And often, the most disciplined thing you can do is admit a mistake, realize the loss, or really, salvage the remaining capital and redeploy it.
You actually follow the rule by realizing the mistake, not by pretending it doesn't exist.
Precisely. And a specific failure mode that plagues conviction investors, especially in smaller companies, is not trimming profitable microcap positions. Microcaps can give you incredible leverage, 3x, 5x, 10x returns. But once a concentrated position doubles or triples, that leverage cuts both ways. Your downside risk is now magnified. And so many investors hold on for too long, blinded by their love for the business, and just watch huge profits evaporate.
So we need some intellectual honesty to counter this.
Yeah.
Let's outline the framework for exits. What's the first step?
The first step is to define exit criteria. And you have to do this before or immediately after you buy. This is your map. It needs to be explicit. I will trim 50% if the valuation exceeds 8x sales or if the competitive landscape changes in this specific way.
That sounds incredibly difficult to stick to when the market is euphoric and everyone's telling you the stock is going to 20x sales.
It is difficult, which is why the second step is crucial. Be explicit about opportunity costs. If that position has grown to 30% of your portfolio, you need to write down what 3 other better valued assets you could deploy that money into.
Make the cost of inaction concrete.
Exactly. And the third step is the reality check. This is the most brutal but most necessary mental exercise. You have to regularly ask yourself, would I buy this stock today at this price, knowing everything I know now?
And if the answer is no,
that is the most valuable piece of information you can have. It signals your capital is probably better off somewhere else.
And the fourth step, this is maybe the deepest one, is separating the business from the stock.
Correct. You can maintain profound conviction in the long-term quality and future of the company, its products, its management. But that conviction does not require or even justify conviction in the stock price at all valuation levels. They are two separate things.
Bringing this whole deep dive full circle then, we see this really rigorous process that's required. It starts with financials, adds the narrative, defines the valuation, and then requires this constant, almost brutal pressure testing.
And this is where Mr. Schmidt's documented process highlights a great modern tool to combat our internal bias. He reveals he runs his finished articles and analysis through AI tools.
Oh, that's interesting.
Yes, specifically to spot analytical gaps, logical inconsistencies, or overlooked comments in his own source material.
That's a phenomenal use of technology. You're not outsourcing the thinking, you're just using it for externalized accountability, forcing you to confront weaknesses a machine can spot that a biased human might just gloss over.
And yet, even with all that rigor, the author confessed to specific gaps in his own process. He admitted to frequently skimping on formalized, quantitative exit criteria, leaving too much to feeling.
We've all been there.
And being inconsistent with that critical reality check. Would I buy this today? Especially after an emotional event like an earnings report.
And those gaps are so common because they touch on the most painful human biases. They require discipline right when we're most tired or emotionally invested. The solution, as he concludes, isn't perfection, but disciplined honesty.
Ultimately, the investors who navigate both the entry and the exit successfully have internalized 2 essential distinctions that separate them from the rest of the market.
On the entry and holding side, it's about enduring that dissonance and distinguishing early from wrong.
And on the exit and profit-taking side, it's about conquering loss aversion and distinguishing fairly priced from still fundamentally undervalued. And the path to success requires using external discipline writing, tools, formalized criteria to manage that deeply uncomfortable gap between your belief and the market's reality.
The market is not always efficient, and it can stay inefficient, frustratingly, for a very, very long time. The rarest conviction of all is knowing when you're betting on that inefficiency to eventually resolve in your favor and when you should just take the win and move on.
Well said. Thank you for sharing these powerful sources with us today.
Now, here's a final provocative thought for you to consider. If you had to write your own investment thesis right now, what is the single biggest contradiction? What's the biggest piece of cognitive dissonance you would be forced to confront in your own portfolio regarding price versus your conviction? That is where your next deep dive begins. We'll see you next time.